Sometimes we find people act in a manner that's exactly the same as their peers. They might copy each other, but thankfully most people think for themselves. They study very hard before making any financial decisions, and in general, they are very knowledgeable about what they get themselves into. Actually, that's what most people think they do, but it couldn't be further from the truth. And that's why you came here for the truth, so let me unveil that for you. Today we're going to cover an interesting topic. This is something that I found to be quite informative, and so I wanted to bring it to you. First, we're going to look at what Goldman Sachs had to talk about, and then I want to look at what's happening with the fund flows. We're going to cover a lot of information that is not discussed in the mainstream, so let's get into it right away. The following charts are from Goldman Sachs, and basically they looked at all of these earnings and conference calls, thousands of them, put all the data together, and then gave us these categories and basically outlined the information contained within them. Sentiment has declined since last summer in both communications and business activity surveys. The blue line is the sentiment in the S&P 500 earnings and conference calls, and you could see how that has declined over the last year. The average of the Goldman Sachs survey track has also come down. So here we are seeing a very unorthodox way of looking at this analysis, and it's very good. I like these type of indicators because they're not PE ratios. They're not all these things that you typically see that can be manipulated, that there's all this data on historically that would say one way or the other the way things are going. We need to start looking a little bit more carefully to be able to determine what is actually happening, because today we live in a topsy-turvy world. Things don't really make sense, and this just gives us some insight as to what's going on a different level. Negative mentions of growth and international relations have disproportionately grown. There are 4 things at the bottom: growth, uncertainty, profits, and international relations. The darker line is July 2018, and the lighter one is June 2019. And you could see basically over the span of a year how everything has been more negative. Now, we have seen the stock market rising to new highs. We have seen the jobs numbers being fantastic. We're looking at all the data coming out, and it shows positivity. Yet when you actually look at what people are talking about, those in the financial industry, those who are actually determining what's happening with the trades and things, they are being more negative now than they were before. Growth is a huge problem here that has grown quite a bit, as well as international relations. This isn't just about China and the US, but we can of course see that this is applying to so many different countries, particularly with their involvement with the United States. I wanted to just show you that because I think it's another way to look at all of this data that we get on a daily basis. There are always these reports coming out. Every month you get this report, the jobs numbers, maybe it's inflation stats, everything else. But when we start to look at these, what I would call second and third level data, that really tells me what's happening if we can put it all together. Equity fund flows have seen huge outflows since December, but the pace is easing. So you could see this chart right now in the negative. While it has come up somewhat and can certainly continue to do so, we have watched as much of this money has been leaving equities. Now, how can that possibly be? Well, we'll get a little bit more detailed into that here. I want to show you the bond rally has been underpinned by huge inflows. So that just shows you how much money has been moving out of equities into bonds, and we have seen so many of these bonds, over $13 trillion worth, in the negative territory. The EPFR collects all of this data. If you don't know what the EPFR is, you probably haven't been watching this channel, but I cover it here regularly. And what you need to know, they take all the information from countries all around the world and they put it all together to give you an idea of where money is moving into and moving out of. And here you could see very clearly where it's going to and from. The rise in equity positioning is entirely driven by systematic strategies, while discretionary investors have been reducing their exposure. Let me be very clear about what this means. The robots are buying, the humans are selling. That's what they're saying. The green line, discretionary investors, that is in the negative, and you look at the blue line, systematic strategies, that is in the positive. So we've got a big disconnect that's happening right now. We are seeing money that is outflowing from equities. We're seeing money that's moving moving into bonds. We are looking at the computers buying up these different assets, and you see that the humans are selling. Something is very, very wrong right now. CTAs, basically the computer algorithms, have also raised equity exposure to near the top of their historical range. That tells us that they are going full pedal to the metal at this time. So I just wanted to show you that because it is very important to look at what the computer algorithms are doing, not just on the way up, but it's going to be much, much worse on the way down. As they start selling, you're going to have the panic that ensues, and most people believe that they will be safe for one reason or another. My money is safe because of this, my investments are safe because of that, but ultimately only time will tell you if that's the case. We have seen the warnings and have seen the instances of bail-ins. We have watched people lose their money. Look at what happened with MF Global, how people, their money in their segregated accounts was taken from them. And of course, I believe at the end of it, after years, some of them got their money back, or perhaps all of them got their money back. I'm still unclear about it, but let's say everyone got their money back. Is it okay that they took it from you for a few years? Are you okay with that, to give a loan to some company like MF Global while they figure out their accounting? Well, no, certainly that is not the case. That is not okay, even if everybody gets their money back. What if somebody had to actually take all of your digitized assets and it disappears out of your bank account? Then you're stuck without that money, let's say for a week, but you got your money back because it's insured and so on. Well, you didn't have your money for a week. This is not okay. What we are dealing with right now today is a series of events that will take place asynchronously. It's already going on. It's been happening since the financial crisis. We have watched the central banks around the world completely diminish the value of money, and you could see that because of looking at the negative bonds, for instance, where people are buying it up because the money is essentially worthless. We are watching it evaporate very, very quickly, and this is not a good sign for the future. Central banks have flipped from hawkish to dovish in the past 12 months. This just shows you the net central bank hikes, cuts of the last 6 months. If you look at it approaching the financial crisis time frame, obviously we can see that they were hiking. Okay, very important to look at this because it's very different than what we saw today. They barely got into that mode and then they started to reverse it. Well, you can see globally something has changed. Almost every central bank right now is moving towards cutting interest rates. Some of them are already in the negative. I don't know what they're going to do in this cycle, but it is very clear that we are moving into that territory right now. I've been looking at this information, and if you look very closely at it, you will see that the central banks are purposely trying to devalue the currencies. It is extremely important to understand that and note that this isn't an accident. This is being done on purpose. This is being done intentionally to reduce the purchasing power of your currency on a day-to-day basis. Very important. And I wanted to leave you with this one last chart. Global bond yields are at 120-year lows. It is unbelievable. The UK, Australia, Japan, Swiss francs, and USA average bond yields, well, we're right now moving lower and lower. We haven't been this low at 120 years. It's incredible, but just to see this happening right now and the value of currency. But of course, this is being done intentionally. We're moving into the negative. If you want to buy a government bond, which in my opinion is not very wise, then of course you're going to get almost no return. Even the 100-year bond coming out of Argentina is going to give you such little bit of return that it is truly something to marvel at. We are watching governments who had bailed out their corporations in 2008 and beyond. They had then take on that insolvency, and it will be passed on through into the next financial crisis when we watch the dismantling of the current financial system. What is being replaced here? Well, I don't know. It's going to be some sort of speculation, but I do believe that something like the IMF SDR will come out as a result of all of this. Not necessarily that, but it's something probably like that. And I do believe what we will have is everybody uses their regular currencies, their national currencies. They do business just as they would before. But on the back end, we have a new supranational entity that is monitoring all of this and making sure in quotes, that everything is taken care of, that nobody gets out of order, just like what they did to Greece. Greece was used as a beta test for what they will do all around the world, where you have, for example, the IMF looking at all of this and being able to decide what happens in these countries. This is ultimately the goal. Whether they'll use the IMF or create a new institution, that is really beyond me. If you found this video informative, please hit that thumbs up button. When you give me a like, you are supporting me and this channel, so I do appreciate that very much. If you want the financial education you were not taught in school, these two books have everything you need from top to bottom, A to Z. All the details are located in the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want some real economic indicators, the statistics that will not make it to the mainstream from page news, well then you got to watch this video. Click on it and I will see you there.